running on top of the Workday platform. But we're leaning in
all
heavily
sorts
into
of
the international
considerations.
market. The international market, which we call international, is outside the U.S., is about 25% of our revenues, yet it represents more than 50% of our opportunity on a global basis. So we're going to lean heavily into it. We're building out here in London. We're building out across Europe. We're adding new technologies, new data centers, and we're adding a lot of people to drive and keep up with the demand.
Now, you've been on the Workday board for a few years, but you became co-CEO at the end of last year. Before that, you were, of course, at Sequoia, the venture capital giant. What are your thoughts on that sector right now? I mean, it looks like it's going through a bit of a tough patch.
Yeah, I've been in the job now 7 months, Ian. I'm super excited to partner with Anil, one of the co-founders and now my co-CEO, probably one of the smartest technical strategists I've ever worked with in enterprise software. And I did serve on the board for 5 years prior to taking on this new responsibility. And before that, I spent 7 years at Sequoia Capital doing investments with my partners there, and taking 6 companies public over that 7-year period that I was there. And it's an amazing industry. It drives innovation. It really fuels the entrepreneurial spirit, and it's something I very much enjoyed. The one thing I've been impressed about here in London the last couple of days is learning how much the European and specifically the UK government is leaning into fueling AI growth. They've announced some investments as well as announced an AI summit that will take place later this year. So, they're in a way, they're doing their own venture capital work as they invest in AI companies.
All right, Carl, got to leave it there. Hope to see you again.
Thank you. Thanks, Ian.
Still to come here on Ian King Live. We'll have a look at how the markets are doing going into the weekend. Don't go away.
And now it's coming from both sides and it's moving this way.
Only about half a mile from the Turkish coast, and it's evident that the boat seriously overcrowded. This is one of the most severe viruses in the world. I'm Alex Crawford and I'm Sky's special correspondent based in Istanbul.
The biggest party Tripoli has ever seen.
That's it got us then. There's a lot of action going on, a lot of hits coming in still. We aim to be the best and the most trusted place in news.
Clearly not had very much to eat at all, a lot of them extremely thin and very frail. Look at her arms, I can put my entire hand round.
This is the cocktail of drugs which the doctors at this hospital have been giving their coronavirus patients. Made for people who want clarity in an uncertain world.
Mother Nature can be vicious, absolutely savage. The world's largest falls now down to a trickle in places. I can't imagine how much plastic is lying at the bottom of this huge lake. Oh!
Close and personal with a rhino.
This is what makes the job so fantastic.
Welcome back. Bit of breaking news to bring you. We've heard in the last few minutes that the UK's Competition and Markets Authority has cleared Amazon's takeover of iRobot. That's the owner of the Roomba self-acting vacuum cleaning business. That deal commissioned $1.7 billion, cleared by the CMA. It's not yet been cleared, I don't believe, by the US Federal Trade Commission, though. So they're not completely past all the hurdles on that takeover yet. Well, last night's gains on Wall Street, during which the S&P 500 and Nasdaq Composite completed 6 straight days of gains apiece, was followed by gains for equities overnight in the Asia-Pacific region. The Nikkei in Tokyo hit another 33-year high, completing 10 straight weekly gains after the Bank of Japan left monetary policy unchanged. Well, in Europe, stocks are also going on into the weekend on a positive note. Here's the current picture. All the main continental European indices in positive territory right now. Talking points this morning include Rheinmetall. Its shares are ahead by some 3% in Frankfurt, and that is on news that the Leopard tank maker is about to receive a major contract from the German government worth billions of euros, we're told. Here in London, the FTSE 100 up a sixth of 1% right now, and a broad-based rally led by the retailers. Among interesting features this morning, Whitbread is ahead by just over 1%. That's on a report in the Times suggesting that it may be looking at possible pub restaurant disposals, while Informa, the exhibitions group, you might recall we had the CEO of that company on the programme recently, its shares up 1.25%. That follows yesterday's upbeat trading statement. Outside the FTSE, ASOS is ahead by another 4.25% after reporting yesterday its return to profits during the latest quarter, while Currys, the electrical goods retailer, is ahead by some 1% on news it may sell its Greek business. On the foreign exchange markets, well, the pound has been trading above $1.28 for the first time since April last year. That's after the Fed, of course, paused interest rate hikes on Wednesday evening. Sterling also up by 0.1% or so against the euro. The single currency, meanwhile, more or less flat against the US dollar right now. As for the oil price, well, it rallied sharply yesterday. It's given away a bit of those gains this morning, but still on course for its first weekly gain in 3. A barrel of Brent crude will currently set you back $75.52 a barrel. That's off a fifth of 1%. Well, with me this morning is Ian Williams. He's Chairman and Chief Executive of Charteris Treasury Portfolio Managers. Ian, good to see you this morning. Every time we have you on the programme, there's a lot of turmoil going on in the gilt market.
Yeah. Well, last time we were on was after the infamous Liz Truss budget and the collapse of the gilt market was going on at the time. And that was a very interesting time.
And now we're seeing gilt yields even higher in some cases than they were.
Yeah, the short end, yeah. So, I mean, if you remember, what we said at the time was that the Liz Truss budget was the catalyst for the final sell-off in the market. It wasn't the underlying cause. Gilts have been falling for the sort of 9 months before she even walked through the door at 10 Downing Street. And she just happened to pick up the blame for the back end of the final sell-off. But the root cause was the leverage that the pension funds were taking. They were buying all these gilts on leverage, and then obviously you have to keep a variation margin, and if the gilts start to come down, you have to keep topping up the variation margin, and it just feeds on itself. And that was the root cause of the collapse in the gilt market. It wasn't really the budget. That was just a catalyst for the final sell-off.
Yeah, so it's essentially supply and demand technicals, really. Then, I mean, the other factor, of course, is that the Bank of England is engaging in quantitative tightening. Is that much of a depressant?
Well, there's a lot of talk from official sources trying to blame train drivers and supermarkets for inflation. Everyone knows the root cause was the quantitative easing, that the massive amount of money printing the Bank of England took out in the QE4 programme, where they just printed £120 billion out of thin air. And that's the root cause of the inflation we're seeing today. And what you're seeing trying to blame supermarkets is trying to blame someone else for a mistake that they made. I think they weren't the only central bank to do it. I just think they maybe did it in a bit more scale relative to the size of the economy, which meant that we probably potentially have an inflation problem that's worse. I mean, it's easy to prove, because if you look around the world and say, oh, well, it's high oil prices because of Ukraine. All countries suffered from the high oil prices. All countries suffered from not all countries suffered from these rates of inflation. It was the ones that were printing money that have suffered from the inflation rate. Yeah. So what we're seeing now is potentially a policy error by the central banks, which was too loose for too long, coupled by a load of money printing. They've now gone the other way, sort of trying to rebuild their reputations. And the Fed and the Bank of England all run the risk now of excessive tightening. So if you look at the yield curve, we've got an inverted yield curve. What that means is the short-ended gilts and short-ended treasury bonds are on 5% yields, where the 50-year and 30-year bonds are sort of hovering around 4, under 4 in the States, slightly over 4 in the UK. The market is telling you an inverted yield curve is one of your best signals that the economy is going into recession.
It is. But you mentioned there the yields in question there. I mean, the traditional yield curve inversion one looks for is with the 2s and the 10s, isn't it? Or the 2s and the 5s.
Or you could look at you could pick any one you like to get a picture. But I mean, it's particularly pronounced if you look at 2s versus 30s. I mean, the central banks can control rates up to 2 or 3 years. After that, the market decides the rate. And the market is setting rates much lower than the central banks. And usually when you get these inverted yield curves, it's the market that usually gets it right. So if the market's signaling recession, you can probably bet you're going to get one. We're really quite bullish on gilts on a 1-year view. We think there's a 4-year bond cycle that every 4 year, 2008, 2012, 2016, 2020, next one is due in 2000. Every 4 years, tied in with the US presidential election, you get a big rally in bonds, and the next one is due next year in 2024. We think the yields are too high. We think the economies are going into recession, and we think that government bonds are going to have their day in the sun. And so we're really, and there's other stuff. The more forward-looking indicators are actually showing negative for the economy going forward, whereas the backward-looking ones, particularly what the Fed uses, like the non-farm payroll, they haven't caught up, but they're lagging. They're badly lagging indicators. So the forward-looking, the US money supply, M2 money supply, is negative year on year for the first time since the Great Depression in 1933. That's really quite scary. Whereas a year or two ago, M2 money supply, when they were printing money like confetti, was growing at 38% a year. That's gone completely into reverse. And now you're seeing big forward-looking indicators of quite potentially heavy deflation or disinflation coming through, which is, I think, very positive for the long end of the bond markets. And it's being borne out. And the more they put the short rates up, I mean, Bank of England probably put short rates up again, it's potentially just going to put long-dated gilt prices up even higher.
Okay. Ian, got to leave it there, I'm afraid, but good to talk to you this morning.
Right,
thank you. Still to come here on Ian King Live, how sports sponsorship has helped Heineken grow as it celebrates its 150th year. Stay with us.